For more stock news updates, remember to press the like button and subscribe. With that being said, let's get straight into the video. To kick things off, we saw Peter Thiel, a co-founder of Palantir Technologies, sell nearly $600 million worth of Palantir stock this week. This brings his total stock sales this year to over $1 billion. Large insider sales, especially from co-founders, often attract attention in the investment community. However, it's essential not to overreact to these transactions, as there are several potential reasons behind them that don't necessarily reflect the company's future outlook. However, it's important to avoid jumping to conclusions based solely on insider trading. Thiel's decision could be tied to a variety of factors that may not necessarily reflect the company's future performance. When it comes to investment strategies, relying solely on Wall Street analysts' price targets to determine whether a stock is worth buying or selling is not always the most effective approach. While these targets can provide useful insights into how market professionals view the stock, they shouldn't be the sole reason for making an investment decision. Analysts' recommendations should be one of many tools investors use to make informed decisions. It's critical to conduct thorough research and consider broader market trends, company fundamentals, and long-term growth prospects. One example of a stock that Wall Street analysts currently recommend selling is Palantir Technologies, which trades on the New York Stock Exchange under the ticker PLTR. According to the consensus of 15 analysts, the average price target for Palantir stock is approximately $27.08. This estimate suggests a potential downside of around 30%. Despite this cautionary outlook, Palantir has garnered substantial attention in recent years as a premier artificial intelligence company, primarily because of its expertise in the field. However, Palantir's decision to focus on artificial intelligence solutions was not a result of the recent boom in AI technologies. Rather, the company has built its entire software platform around artificial intelligence from the very beginning. This long-term commitment to AI has given Palantir a considerable advantage over many of its competitors who have only recently begun to explore the potential of AI in their operations. Palantir originally established itself by developing sophisticated artificial intelligence software for government agencies. These insights provided users, such as government officials and analysts, with the most up-to-date information possible, allowing for more informed and timely decision-making. This capability made Palantir a critical player into the intelligence and defense sectors, where accurate and timely data is essential. As the company grew, its leadership recognized that Palantir's software could also have significant applications in the commercial sector. This realization led to an expansion beyond its traditional government contracts and into the private market. However, government clients still make up the majority of Palantir's customer base, contributing 55% of the company's total revenue as of the most recent quarter. Palantir stock has recently experienced a dramatic rise in value, largely driven by increased demand for its artificial intelligence platform, often referred to as AIP. This platform represents a significant leap forward in how businesses can incorporate AI into their daily operations. Instead of using artificial intelligence as an isolated tool, AIP enables companies to integrate AI throughout their entire business, embedding it into every workflow. This allows organizations to have full control over how they apply artificial intelligence within their processes. Rather than simply relying on a generative AI model, AIP offers more comprehensive and flexible solutions, helping companies maximize the value of AI in ways that align with their specific needs. This level of integration has made AIP extremely popular, particularly with Palantir's US commercial clients. In quarter 2, which ended on June 30th, Palantir's US commercial revenue saw a remarkable increase, growing by 55% year over year to reach $159 million. Although this revenue segment currently accounts for only 24% of the company's total earnings, it is by far the fastest growing part of the business. This rapid growth indicates that Palantir's expansion into the commercial market is gaining significant traction. Moreover, the number of US customers surged by an impressive 83% year over year, climbing to 295 clients. While this customer base may seem relatively small compared to other software-as-a-service companies that often serve thousands of clients, it suggests that Palantir is targeting high-value contracts with fewer, larger organizations. When analyzing Palantir's US commercial business, one noteworthy metric is the average revenue per customer. By annualizing the revenue generated in quarter 2 and dividing it by the total number of US customers, we find that Palantir earns approximately $2.16 million from each US client. This figure highlights the fact that Palantir's software solutions come with a high price tag, which limits the pool of potential customers. After all, not many businesses can afford to spend over $2 million per year on software solutions solutions, even if they offer cutting-edge artificial intelligence capabilities. Nevertheless, this has not stopped Palantir from continuing to thrive. The company reported total revenue of $678 million in Q2, representing a year-over-year growth of 27%. Additionally, Palantir posted a profit margin close to 20%, further solidifying its financial position. Despite Palantir's strong business performance, the company's stock has become the subject of scrutiny due to its lofty valuation. At first glance, Palantir's stock price may appear relatively affordable, trading at around $40 per share. However, a deeper examination of the company's valuation tells a different story. Palantir's stock currently trades at more than 36 times sales, a figure that many investors would consider excessive. Historically, stocks that reach such high price-to-sales multiples tend to underperform in the long run. When a stock trades at a multiple significantly higher than its growth rate, it often indicates that the market has overvalued the company's future earnings potential. A good rule of thumb when using the price-to-sales ratio is to avoid stocks trading at multiples greater than their expected growth rates. To provide context, if Palantir were to achieve a 30% profit margin and grow its revenue by 30% annually for the next 5 years, it would still be valued at 31 times earnings. This would be considered an extremely high valuation, especially if the stock price were to remain flat during that time period. In other words, even under highly optimistic growth scenarios, Palantir's current valuation would still be difficult to justify. For Palantir to reach a more reasonable valuation, the company would need to not only sustain its current growth rate, but accelerate it significantly over the next 5 years. This is an exceptionally difficult task, especially given the competitive nature of the artificial intelligence and software industries. If Palantir fails to meet these high expectations, its stock could see a substantial decline, which is why many analysts are advising investors to sell the stock. Ultimately, while Palantir's business operations are performing well, the stock has risen to a point where its valuation no longer makes sense. As a result, I believe that Palantir stock may be a sell. At the very least, investors should avoid purchasing additional shares until the company's valuation returns to more reasonable levels. In the meantime, it's worth monitoring how Palantir continues to evolve, particularly as its artificial intelligence solutions gain wider adoption in the commercial market. Peter Thiel's sale of over $600 million in Palantir stock this week, combined with analysts' price targets, suggests concerns about the stock's current valuation. Despite Palantir's strong performance in both the government and commercial sectors, its stock has become significantly overvalued. With a price-to-sales ratio of over 36 times, the stock reflects unrealistic growth expectations. Investors may want to consider selling or waiting until the valuation becomes more reasonable before purchasing more shares. With that being said, I will see you in the next video.